Another nice red open here in the market, which I know we all love.
That's not the color you like to see at 9:31.
No, I'm just kind of going through. Interesting. A little bit more of a mixed bag today than
Yeah, you're breaking up
Is
on
that
me.
my
we've
internet?
got the last couple of days. So we'll do that in so I can. Oh,
You there? You're breaking up, Nathan. You there, Graham?
I'm here.
Yeah.
yeah. Sorry. Just I was trying to open up the other room so I can see the chat.
Okay.
Yeah, what a wild start to the day.
Dude, some of those back and forth bars just on the lower time frames were wild.
Yeah. And now we they just bounced again. Let's see.
Yeah, we got it is a bit more of a mixed bag today. So I'm just kind of distracted looking at what we have right now as things are kind of rocking back and forth. Like there are definitely a decent amount of tech names down. Let's see what XLK is right now. XLK is down 0.36%. So it's not like it's down 1% driving everything else down. It's kind of in line. And then some of the staples and other things are down. We've got Hood that's up, Energy that's up a bit. Gold was up. Now it's back down. Yeah, much more of a mixed bag today. But we'll be interested to see SPY bouncing right now, only down about 0.2% now.
Yeah, and we just had the Vold was trending lower all morning, and over the last 5 minutes just made new all-time high or new highs for the day, which is crazy.
Yeah. Huh. All right. Well, I could get myself really distracted looking around and trying to figure out what things are actually dropping in real time here, but I won't do that to you guys. We got some meat and potatoes for you. Actually got kind of an interesting case study I want to walk you through because, I mean, this has to be the most common question I get about, do I exit early? Do I use stop losses or things of that nature? And so I'm going to walk through a little bit of that with a case study here, and hopefully it will answer some of your questions on that. All right. Let me just open up again so I can see the chat. Guys, is my audio now coming through? Is it just people who have the low latency that's an issue? Okay, cool. All right. Well, speaking of crazy markets, yesterday it happened again. We had a big, ugly drop in the market. And where I typically get a lot of emails is when we have a big drop and my overnight option members send me an email like this one. He said, is this a market recession? Your SPY trade has turned into a big money loser. And well, actually, yesterday that was not the case. But I'll walk you through why that was not the case. But I totally understand the reaction. So on Tuesday, so 2 days ago, we set up our overnight option trade for Wednesday's expiration. Like always, we always use, that overnight expiration. And our line in the sand was right here. So this yellow line is where we needed the price to be above at the end of Wednesday's market action. Although we don't wait for that, we use a target. But fundamentally, the trade has to be above there for it to be valuable. Well, the market drifted slightly down overnight. If you guys remember, yesterday's market didn't really open a whole lot down. Pretty quiet open, actually. And our position was around break even right at that 9:30 a.m. open. But then things got pretty ugly, if you guys remember, pretty quick. And this is where I always start getting a lot more emails from my members right around this point. And so I get, hey, our trade is down. Should I be exiting? Why don't we have a stop loss on this trade? I knew I should have exited earlier. Nate, there's no alert. You haven't told us what to do. What do we do? And I get it. This is hard. As a matter of fact, I would say this is probably the hardest lesson that I teach, which is that in reality, as much as it's challenging to just sit there and not do anything and sit on your hands and say, yeah, if we lose, we lose. That's the reality of the trade. No one likes that answer. But the reality is that our default approach is actually to do nothing in these situations. Now, remember, one of the keys to spreads is that we're no longer fighting time, right? So we don't have a call option where we're fighting time. So instead of fighting it, we can actually use it to our advantage. So if this was a call option, if I bought a call over here, the value curve would look something like this, right? It would curve down and get steeper and steeper as the time on the option ran out. So in this case, it would make sense to exit early. If you had a call option, it makes sense to get out earlier because you want to get out while there's still some time value left on your curve. And even if it does bounce, even if it bounced up to your entry later, up to 639 on a regular call, you're still going to lose money because you haven't overcome the break-even price. That, you know, that's the implied volatility stacked onto where you entered. And so it does make sense to enter early. But our debit spread is more like this. Okay, excuse my ugly drawing, but it's something like this, where it's going to be relatively flat when price is flat, and then it's going to react and go down. And it's actually going to go down more quickly early if price is down. And then it's going to be more flat at the bottom, assuming price were to stay down here. It's actually reacting much more closely to price itself because it doesn't have to fight the time decay layered on top of the trade, right? Okay, so let me just ask in the chat, does that make sense? So the debit spread is going to react in real time, especially on a short-dated option like this, more closely to price itself because it's not fighting time decay layered on top of the price where it has this curve. It's really just looking at price relative to this line in the sand. Now, that's actually really great news for us because it means that it will also respond positively with price versus a call option that might lag super, dramatically behind price. A debit spread can react very positively. Another way to think about it is in terms of real-time risk versus reward as the trade progresses. And this is something that I've shared before. You guys might be familiar with it, but this is another way to think about your trade. So if you imagine that you take a trade here and you have a line in the sand here, like most of our debit spreads would, and an expiration on July 11th, what you're saying is price needs to be above this line on July 11th. If you paid $4 for the trade, then obviously you have $1 left of potential reward because it's a $5 spread. Okay, so that's the reality of any spread. Whatever you buy, the other side is going to be your profit potential. And as this trade moves, so does your risk to reward. Your risk to reward changes as the trade moves because you can't risk what you no longer have. So like in this situation, if on day 4, now you're down 110 plus 150, the trade is only worth $180. So you're no longer risking $400 because you don't have $400. You have $180 of value in the trade. But if the target hits, it's still worth the full $500 if it expires. And so therefore, you're risking 180 to make 320, even though you started out risking 400 to make 100. Your risk to reward is changing in real time. Then as the trade progresses, your risk to reward changes over and over and over because it is based on what's actually happening with the real value of the trade. Okay, and so then maybe you get to a full profit, and even though the trade was only worth 180 here, now it's worth 500 here. So on Tuesday's trade, our target was about 20%. So in this scenario, if you traded 10 contracts, the average price is about 70 cents, you'd invested $700, and your potential was 140. Now, no one in the chat yell at me for having a negative risk reward. We'll cover that in a different lesson down the road. That's the other massive misconception that I think people have that they kind of need to be beat out of. But ignore that for a moment with me and just know that you would have risked $700 for a potential of $140 in profit if the trade was winning. Note that the total value of the trade is $840 at the target level. Okay, so I want you guys to remember, you risk 700 to make 140. If it hits the target, the trade is worth 840. That'll come back later, and maybe I'll give away a prize to the first person who answers the question correct in the chat now that I've given you the hint of the $840 value. Now, when the market dropped here, the trade was down 80%. So how much could we have made if it won now? How much profit could we have made on this trade at this particular time? All right, I'll give you guys 60 seconds. We'll see if anyone gets this right. Dave, I feel like we need to play some like Jeopardy music or something while I wait for the chat here. Let's see if anyone can get this right, because it's actually kind of tricky. But I gave you a pretty big hint by telling you what the total value of the trade was worth. Oh, there we go. Wow, nice work, Dave.
The best I could do without violating copyright.
That's pretty good. All right, good job. We got some good guesses. The chat a little quiet in the chat today. We only had about 10 guesses in there, but I do see at least one that is correct. Most people think that you could make 140 on the trade still, but that's actually completely wrong. We're no longer in a position where we would make $140 on this trade. The real time value of the trade, what it was actually worth right now, is $140. So if you close the trade here, that's what you would get on the trade. You'd get $140. So that's what it's worth, period. End of story. It's not worth $700. It's worth $140 because that's what you could get out of it at that time. But remember, the total value of the trade was $840. So what could you make in here? John G got it. Well, your new risk reward at this point is $140 to make $700. Okay, because the trade is only worth $140, but the value is still the same $840 if the trade hits the target. So your trade, your value, your risk to reward has fundamentally changed in real time. It's not like you could exit the trade and just go back to your previous account value. No, you're down. You only have $140 left on the trade. But at the same time, if it hits the target, it's still worth that same $840 to begin with. So John G, we're gonna have to send John G a polo. He got it with the $700. That's what you could stand to make in this particular time. Now it actually dropped a little bit further. If you guys remember, I think at this point it was down about 95% on the trade, which was brutal, which left about $35 of value on the trade. So now the risk reward is $35 of risk that you could leave on the table with the potential to make $805. Okay, is this making sense to everyone? Because I think this is one of those big misconceptions when they think about should I exit. People kind of think like they're almost like they're salvaging the original trade. But there is no original trade. There's only the real-time value of what your trade is worth. That's how much money you could get. If you took the trade here, your account balance would still be down, $665 because the trade is legitimately only worth $35 at this point. And if it's the target, it is legitimately still worth $840, which means you legitimately would make $805 from this point. It's a little bit weird to get your head around, but it's really important if you actually want to kind of evaluate trades correctly in real time. And yesterday, that $35 trade-off for $805 of potential profit would have been a really, really good trade-off because what happened in the market yesterday was that it ripped up, and before closing Playbook, we actually hit our target on this trade that was down 95% on the overnight option. So we snuck out another winner on that trade. So just to be very extra clear here, I want to be super clear about something. When a trade is down 70 or 80%, we usually do lose. Okay. The point here is not to always keep it open because we're going to win. Hey, just keep it open. We're definitely going to win. That is not the point. The point is that the few times that you flip losers into winners make all the difference. So those few times, it's not that it's always going to win. It's the couple of times that it does win make all the difference. I'll actually prove that to you here in a moment. So then the obvious question is, because I didn't actually say this part outright, Nate, are you saying you're willing to lose 100% of the value of the trade when you're wrong? And the answer is yes. For me, that's one of the best parts about trading this way. I can actually use the structure of the trade as my max risk and give it the maximum time to hit the target, right? So if I am willing to lose 100% of the trade, that lets me give it every second of the trade in order to hit a target. So for me, that's a big, big win because I now don't have to worry about, oh, shoot, should I get out here? Should I get out here? No, I know my risk is $500 or it's $1,000 or it's $1,500. That's my risk. And now I can feel free to give it all of the time to get the max amount of time potential for that trade to come back and hit my target. So I like to think about it like this. Most stocks, as we know, they're not going to move in a straight line. A stop loss is like saying, hey, I want to lose money anywhere in the zone. If it goes against me at all, I want to lose money. Please take me out and take my money. But a profit limit with no stop loss is saying like, hey, I want to make money anywhere in this zone. Anywhere it gets up here positive, take me out. Just give me an opportunity to get out. Like that QQQ trade I showed you. Graham, I know you weren't on Closing Playbook. I got filled on one of the craziest trades ever yesterday. I did a 643, no, 643, 646 QQQ debit spread after the big drop, thinking we might get a bounce back. And then I just put a $1.60 target on it. And it filled when the Qs were at like 664. Wow. So even the intrinsic value was only $1, and I got filled at my full $1.60 target for like a 95% gain on the trade.
That's awesome.
So I said, hey, that's one other reason to have a target on the trade, just in case you get a wide bid ask or something wonky happens. Give the market lots of ways to pay you. So for the average trader, I really can't think of a bigger advantage than simply giving yourself more ways to win and less ways to lose. A stop loss, in my opinion, is giving yourself more ways to lose. A target is giving yourself more ways to win. Okay, let me prove it to you here in a way that I think is pretty wild. Okay, I like to always just use some of the data here to kind of show these examples, and this is one that I think is really powerful. So this is a test. You don't have to worry about the details of the test exactly. That's not really the main point, but it's trading the SPY with a 21-day expiration, and as you can see, it's a nice little test. It goes from $25,000 to $209,000 over 10 years. Again, pretty darn good results. Notice the target is 30% and the stop loss is 50%. Now, guys, I want you to take note of these numbers. Specifically, I want you to take note of the win percentage, which I'll pop in the chat here. The win percentage is 76%, and then the ending capital here is $209,905. Now, what I'm going to do, and you guys can guess in the chat the result as it's loading if you want. What I'm going to do is I'm going to make one adjustment to this entire test, which is that I'm simply going to take the stop loss out. And you guys can guess how it's going to impact the trade. So I'm going to go down here. I am going to remove the stop loss completely. So there is no stop loss on the trade. And I'm going to rerun the test, which will take about 2 minutes. Because it's like 2,500 trades. So it's a lot of data that needs to compute here. But we're going to see what happens here with this test when we make this change. Everything else the same. The entry the same. The timing the same. Everything else the same, except for we're taking out the stop loss, but we're keeping the target. Okay, so the target stays on, but the stop loss goes away. Where now we're just saying, listen, every single time a trade is open, give it the max amount of time. If it loses, yes, we lose 100%. But if we, if we hit the target before that, then we will we'll take our money and run. So our average loss is definitely going to be bigger.
Hey, Nate, while we're waiting on that to finish, a couple of people are just saying they're having some trouble wrapping their head around it. So if I could maybe throw in my little version of this, which is, when you place a trade and then it goes to a certain value, you are emotionally thinking about, well, this is how much I spent on it. This is how much I've won or lost. This is where I am. What do I want to do? I want to cut my losses and things like that. And really what happened, what you paid to get in it, as emotionally difficult as it is irrelevant. It doesn't matter what you paid to get in it. It only matters what it's worth right now. And so what you're risking, whether you stay in the trade or get out of the trade, you're risking what it's worth right now. And so when the price drops, you're feeling all the loss of what you put in it and versus what it's worth now. But what you're making a decision at the moment to get in it or to stay in it or get out of it, you're making a decision based on what it's worth at that moment. So what it's worth at that moment is way less, and your potential is the same as your original potential. So you're risking what it's worth right now. All you're going to get is that $100 out of the $800 you originally spent. It's only worth $100. Do you want to risk that 100 by staying in, or do you want to walk away with the 100? It has nothing to do with the 800.
Yeah. Yep. Okay. Thank you for that, Dave. And by the way, this test always blows my mind. Okay, so the ending capital here is now it's about 2 million, 1.96 million. Oops, entered a dash in there. But here's the thing that's actually the crazy part to me. The win rate went up. It didn't go up that much, guys. You would actually think, I would have guessed, taking the stop loss off, the win rate would have went up into the 90s, and that's why we make so much more money. It didn't go up that much. It went up 10%. But when I said I would prove it to you, this is what I mean. We only flipped 10% of losers into winners, and the portfolio went from $200,000 to $2 million just by flipping those losers into winners. And so this is the data. You can argue the stop loss thing if you want, especially with debit spreads. I've tested, hundreds and hundreds of strategies. This is almost unanimously the story. When you take a stop loss away, but you keep a target, the results get dramatically better. And it's almost always because you're switching a couple of losers into winners. And over time, that makes a dramatic difference. So again, hopefully this is helpful to you guys and kind of shows you not just the theoretical concept, which I tried to walk you through, but also just a data point here. And you can run this a million different ways and you'll keep getting data that confirmed it. So hope that helps. And Graham, I'll hand it over to you. Sorry, I said I was going to take 5 minutes and I took 23 minutes. So really,
we'll have to fly through my end, and I'll save some of it for tomorrow. I was going to do a quick sort of state of the markets where I see things coming off of Tuesday's class, which I did tell you guys Tuesday. I thought we were going to see a pullback this week. So far that's happening. Hopefully it doesn't go too far, but we'll see. We'll see what happens. All righty. See if we can do this. Okay. Today, since the markets look like they may be down for the third day in a row, although we are getting a crazy buying spree ever since about 10 o'clock on the dot, the market's flipped and they're looking really strong right now, which can be extra good for what I'm going to show you today. And yes, we had some questions about a scanner. I'm going to give you guys a scanner here in today's class. And Nate, this is also something we can check on the closing playbook today, 3:30 p.m. Eastern. It actually applies best to taking this type of trade near the end of the day because we get the full day worth of market data. But today I'm going to teach you one of my favorite ways to identify stocks with a strong likelihood of gapping up overnight, and then how we can apply options on them. The cool thing too about this strategy is because options expire on Friday for the most part, these trades are best to be used on Thursday going into Friday. So our timing is perfect. So today I'll cover this approach to spotting stocks that are primed to jump overnight. And then I will show you option selection. And again, we can do this. We can have some fun with this today on the closing playbook. So we may not get to any trades today just because our time is already half eaten. No thanks to Nate. No, I'm just kidding. That was awesome.
Sorry, guys.
We will apply the trading portion of this afternoon if that sounds good to everyone. So the technical pattern that we are going to be looking for here is called a bullish fade trade. So you may have heard of things like reversion to the mean taught in the stock market, which essentially means that stocks in a bullish trend typically stay that course of that midline. So if we look at the swings here in the S&P on this chart, there's higher, there's lowers, higher, lowers, but if you just draw a line, slice it in half, you can see it follows that midline. But stocks don't move in a straight line. Again, they go higher, they go lower, they go higher, they go lower. But they eventually always revert to that mean. Can everyone see what I'm talking about here? How you draw a midline, that's technically the growth of the stock market there, but obviously it gets above it, it goes below, it gets above, below, and always comes back and crosses and touches that line. Well, with the bullish fade trade, that's exactly what we're looking for, but we're just doing it on a much, much shorter time frame. So generally, for this trade to work, we want to see a good, strong stock that has fallen 2 to 3 days in a row and buy it at the end of the day for an overnight gap high. And this is why it will be perfect for the closing playbook today. So we want to see a good, strong stock revert away, and then we can buy it for a snapback overnight. So here's one on Google, down 1 day, down 2 days. You buy it. Ideally, you sell it back overnight for a gain the next day. This one was a 60% return there. We had a trade before that on AXP. You can see this one was 3 days down. So it fell 1 day, 2 day, 3 days. Buy it at the end of that third day, sell it the next morning. You can hold all day. If you did a wrap order, this one would have paid. But you can sell it the next morning. And this one was 54% overnight. Again, the options work best trading this on Thursdays because tomorrow's expiration day. So we can use some of our fancy-dancy spreads to really multiply the gains here. So typically, I would like to buy these as close to the 4 p.m. closing bell as possible and then sell the next morning. And why is that? Well, if you guys have I know we got a lot of overnight options folks here. If you're in overnight options and you've seen this chart before, give us a yes in the chat. This is why we like to buy as close to the market closing bell as possible. And that's because during the day, stocks tend to stagnate, right? This is if you bought the 9:30 open and sold at 4 p.m., how did it work out over the last 30 years? Not so good. However, if you bought the 4 p.m. closing bell and sold the next morning, total different story here. Stocks tend to move higher overnight. So stocks don't make much during the day, and they tend to go higher overnight. You guys know this. Again, this is the core driving principle behind the overnight options. And now we can use it on individual stocks as well for maybe some bigger results. So let's walk through this trade step by step. And then again, we'll go build a scanner together. I also have one in StockFetcher that I'll share with you. And then one for Thinkorswim, which you can add if you don't have it already. Of course, guys, keep in mind, this scanner is in the opening playbook members area. So if you paid the $1, you got lifetime access. You can access these scanners right now in the opening playbook members area. I will post them in the chat here too, but that way you can go back and add it later if you're watching this as a recording or just want to go back to review. So our first step here is we want to build a scanner that's going to look for exactly what we talked about. 2 to 3 days down, so we can look at them at the close and find the best stock. So I'm going to build this in StockFetcher for you guys first. And then, of course, let me go ahead and give you guys the codes right here. I'll split these up, make it a little easier to see. Okay, well, I can't post links. I forgot. Well, the links are there in the chat if you want to copy and paste those into a browser. I believe that would work. Let me see. Okay, that worked. Oh, thanks, Nate. All right, so Nate posted the links for you guys. Just copy those links real quick. First thing we're going to do it in StockFetcher, and then you can do it in Thinkorswim. Obviously, if you have Thinkorswim, ideally, you probably know how to install a scanner by now. If not, we have resources available for you guys, as well as the customer service live, which is a great place to go. So step one, we're going to build a scanner in StockFetcher. Now, I already have one, so I'm not going to save it, but let's pretend we just go to StockFetcher.com. You can have a free account or a paid one. I think the paid one is $7 a month. The free one, there's some limitations to it, but you should be able to set up some basic scans. First thing I'm going to do here is no, I don't have it for TradingView. Nate, does TradingView even run screeners now?
I don't think they let you pre-code. I mean, they have their own, but I don't think they let you use code on scanners. If someone knows how to do that, let me know, because I tried to work around that for like weeks and couldn't get it except for in their default, settings. All
right. So go to StockFetcher.com. Of course, if you have Thinkorswim, I'll show you in Thinkorswim too. New filter right at the top. And then I'm going to go to this code here. Let's just copy and paste the whole thing. I'm going to copy it. So you can right click, copy. And we're going to go back to StockFetcher. And this yellow area is where we're going to paste our code. And this, you'll notice, has 3 days line item in here. If you guys want to just look at stocks that have fallen for only 2 days, you would just remove this line item. All right. Again, call it whatever you want to. Save it. I already have it, so I'm not going to save it and overwrite myself. Yeah, Pete says load the scanner in ChatGPT and ask for trading view. That is probably a really smart thing to do. All right, so this is going to give us stocks that have fallen at least 3 days in a row. So you can see Tesla here, down, 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 right? WBD, down, down, down. AVGO, Broadcom. This might be a good one to do, actually. But down, down, down. You can actually see this one's down 5 days in a row, which makes it even better. Now, one quick note here that I do want to make is that the strategy works best. Actually, I think I covered this in a moment in the slide deck. However, it works best when the stock market is in line. And wow, that's an ugly chart. All right, let me just do this. So the S&P is now down 1, 2, 3, 4, 5 days in a row, which means we may be getting to the point of being, we could still keep going lower. It would not shock me, but we may be getting to the point of a little bit of overexhaustion to the downside, right? We're just playing the odds here. We're playing reversion to the mean on a much tighter time frame where, hey, if it's gone down 5 days in a row, it's probably overdue to have a positive day here at some point. That's the general premise. Now, today's price action is a bit crazy, right? We were down 0.5%. Then we might have even filled the gap. We got real close to filling that gap. Nate, did you hit on overnight options with that?
No, I did not quite hit.
All right. Well, still looking a lot better than it was 30 minutes ago. So this is why we're going to wait to place our trades until the end of the day so we let the market settle. Again, like if the market sell off from here, you would hate to be buying, Meta, if Meta's going to fall off another 2% this afternoon. Let's just wait until this afternoon to place the trades. But my point is when the S&P is in line with this strategy, it's the best time to use it. So hopefully that made sense. All right. So we have this scanner set up. Hopefully by now you've clicked fetch stocks, or if you have the Thinkorswim version, where did I put that? If you have the Thinkorswim one, if you use that 3 days down, here's the code. I also have short links. Let me pull up the opening playbook members portal. And I will share that with you guys, the short links. If you want to use Thinkorswim, again, here's your members portal. Scroll down here. Trading codes and scanners. This is included for free. Fade trade 2 days down. Fade trade 3 days down. I would use this one today because most stocks are going to be in this bucket. This is going to give you a lot of stocks. This will give you fewer stocks. Since we already have alignment in the S&P, I would use this one that's just a little bit more filtered. So you click there. Again, this is a quick start link. If you copy and paste that, you can paste that into Thinkorswim and have the same code. All right. So now we've got this in here. The code is in here. Step 2 is to sort for the strongest stocks, like we typically do with sectors or anything else we're looking at relative strength. So I'm going to go here to table. So I've clicked table. Now we've got a list of stocks, but you can see here, if we're looking at the average percent, this is over a 1 month and 3 month average, -2%, 7%, 12%, 16%, so on and so forth. It's random. I'm going to sort this for strongest to weakest. So ideally, we want to trade the strongest stocks for that snapback. So now that I've done that, I'm trying to move slow for you guys so I don't leave anyone in the dust here. Once I've sorted there, I'm going to go back to the charts just because I want a quick visual. And let me make sure I'm not missing any notes I had here. Okay, back to the charts for easy viewing. So again, let me just go to AVGO is one that I really like right now. All right. You can see there's a ton right now because there's 19 that's hit the scanner today. That's not usual, but it's also because the markets are aligned. Markets have gone down multiple days in a row. It would make sense that multiple stocks have done the same thing. But again, we really want a strong stock that's made a sharp snapback, just like AVGO has, and then we can trade it with the options expiring tomorrow for an overnight move. Micron is another good one. Wow, I did not know Nike was even in a slightly bullish trend at all. News to me. Goldman Sachs, another good one that's been a very strong stock. Anyways, there's a ton of stocks for you to go through here. Tesla can be a fun one. But let's go ahead and take a look here at AVGO. Again, I'm not going to place the trades just now. We'll do that in the closing playbook, but just so I can walk you through the thought process, we'll take a look at that in a second. So when you're looking for stocks, let's go through some good and bad examples of what stock you may want to buy or avoid. So here's an example of Fortinet. This was the 2-day down example because most stocks weren't selling off at this point just yet in February. They were getting ready to sell off, but not yet. So Fortinet, you can see here, down 1 day, down 2 days. Good stock. You buy it, gaps up the next day. Everyone hopefully can see that. That's a perfect, picture-perfect setup there. This is something that I would avoid. If a stock is coming off earnings or news, probably pass on it. It's going to move on factors outside of just price action. This is a price action trade. And so if it's coming off news, there's other things cluttering that price action. So here you can see take two, big pop on earnings. It did set up technically. It actually technically would have worked. However, it's just not, there's other factors at play here outside of just our filter. Here's a good one. Here's a really good one. And this is why I'm interested to see what happens this afternoon. If stocks do want to return back to the lows on the day, we'll probably get some setups that look more like this. So here is JP Morgan back in February. You can see this was the 2-day down scanner. Again, down 1 day, down 2. But look at this. Look how big, hard, and fast this JP Morgan sell-off was. That's not a small candle. Like here, let me just find out. Here, I mean, that works too. I'm trying to find one. Small candles. Do you see what I'm saying by small candle? This is a big body. Big body sell-off typically give us big body results the next day, which is what happened here. So JP Morgan down, big down. You buy the close, pops the next day, looks good. So obviously I look to avoid earnings. I want to avoid stocks that are, short squeezing. They're in the news, all sorts of stuff like that. Just because we just want to trade based on price action. So Casa says AVGO has earnings in 13 days, and you are right. However, we're not holding for 13 days. This is going to be an overnight hold. So Costas, that's great. I'm thankful you pointed that out, but it's not going to be affected by the news just yet. So preferably, we should be trading strong sectors that are leaders, or strong stocks that are leaders in their sectors, like we talk about on Tuesday. So Tuesday, does anyone remember what the top sector is right now, both seasonally and on relative strength? And I'll give you guys a moment to see if anyone remembers from Tuesday. You might not. There you go. We've got one. Yes, technology has been the top sector. It passed up Bitcoin actually in relative strength, which has only happened twice since we've been doing this show. This was the second time. And seasonally, it's also very strong as well. And if we look a little bit deeper under the hood, we know that semiconductors typically very strong in August. So that's why we really like AVGO right now is a semiconductor stock, which is in the tech sector. It's also been a very strong stock, and now it's setting up this bullish fade trade. So here's our general rules we want to follow. Again, we want a strong stock, leader in sector, no earnings within the next, I would say, 48 hours. We want at least 2 down days. If you can get 3, better. If you can get 4, better. 5, even better. And then we also want liquid options. So typically large caps with weekly options is what I look to trade with this strategy. And again, Thursdays are perfect because tomorrow's expiration day. So we get all of that time decay working in our favor. So let me just pause here real quick and see if we have any questions. Sam, how do you identify a squeeze play? I guess I don't have an exact rule for you, but what I mean is I'm avoiding stocks like GameStop or the crypto miners. You can trade them, and when they work, they can pay big. There's just other alternative factors at play there outside of just price action. Versus like AVGO, it doesn't have a huge short interest. NVIDIA, relatively speaking, So it's just the stocks with the huge short interest that I probably wouldn't use this on unless you just want to go for a monster out of the money move, then be my guest. Apple's also down over 3 trading days. Cool. We'll take a look at Apple as well. Oh, yeah, you were right about Apple. That one looks really good too. Okay, yeah, great point. You can use FinViz to filter out short squeeze stocks. I don't know if you can do it in Stock Fetcher. That'd be kind of cool I'm not sure if there's a filter for short interest. Let me just look. No, I don't see. I mean, I'll have to Google it, but I don't see short interest on there immediately. All right. 2 rules for improving our accuracy and profitability with this style of trade. Again, rule number 1, we want a strong stock. The way to improve accuracy is instead of looking for 2 days down, look for 3 days down. So you can adjust that code here. I'll just show you real quick. Again, the code I gave you already has this in there. That's this line. So you can see this line item here. It says we want to see where the close 3 days ago is greater than the close 2 days ago. That's what that means. So if we look back 3 days, it was higher than 2 days ago. If you want to go even more strict here, you can set it up even more. It'll filter out even more stocks. So this would add a 4th day. Let's see what happens. 8 results. So we went from 19 results to 8. Look, like AVGO is still in there. So again, you can play with these different elements here to get to what you want. If we just do 2 days ago, we're going to see a whole bunch of stocks. 68 results. Yes, this should be recorded. So now we have 68 to go through. That's why I said today is a good one to use the 3-day filter, because we don't want to flip through 68 stocks today. Versus typically when markets are going higher, you're only going to get a handful. Apple does look great. AVGO looks great. And again, we'll trade those today in the closing playbook. But let's go ahead and get you guys set up with everything here so we're ready to rock and roll this afternoon. So again, if we do a 3-day rule versus 2-day rule, that gives us an extra day of a stock reverting away from the mean, which then means that snapback could be even stronger the following day. So it starts to get to extreme levels, makes it even better. Well, starting to lose my voice. Makes it even better for when we come back the next day. Rule number 2 for improved accuracy. And again, it's perfect we're doing this today. You want to time it up with the S&P 500. So when the S&P 500 is down 2+ days in a row, that means the most the market moves with it, that's going to increase our probability, our win rates. Versus if the S&P has gone up for 5 days in a row, and it could be reverting to the mean to the downside, it may not be a high conviction trade for us to take a stock to the upside, because that's going to be fighting the tide. Hopefully that makes sense. So ideally, the perfect setups happen when everything is in alignment. So for example here, let's look at the days. These are going to be our perfect sort of setup days. And this is just a screenshot from earlier this year when I did this training. But here you can see down day, good day to align your trade. S&P went up. That's going to carry a lot of the market up. Not every stock is going to go up that day, but a lot of the market follows the S&P. All right, here we go. Down day, next day up. Big down day, next day up. Let's look here. Down day, next day up. Hopefully you guys are getting the picture here that when we get consecutive down days, typically that works. So let's look at this one. Actually, I do want to point out this next one because we don't want to look at the color of the chart. We want to look at the closing prices. So here's a down day, right? Red, down. Next day is green though. So we might look at this visually and say, well, that's not a good trade because the S&P went up the next day. But it's kind of a trick question. It's a play on the eyes here. Did the S&P go higher overnight? No. It closed here the first day, closed here the second day. Even though the body is green, the day's move is red. So 1 day, 2 day, look what happened the next day, snapped higher. Same exact thing here. Down day, green candle, but it's still a down day. Next day went higher. So we're getting this same setup right now in the S&P 500. We're actually getting, I think this is our 5th consecutive down day in a row. And as you know, that's not super normal. Oh, I got to make this small screen. So down day, this is green, but that's a down day. Closed here, closed there. So 1, 2, 3, 4, 5. This is turning into a position where this is looking like, hey, maybe the markets have overreacted to the downside. And it's due for a reversion to the mean in the short term to snap back higher. All right, moving onward. A good reminder here. Let's go ahead and just set a mental note. I say this for you guys all the time. For our gap fills, the stocks on a watch list. There was something the other day that I talked about setting a mental note, but it's always good to have these mental notes that anytime you see the S&P down 2+ days in a row, especially if we get a larger than normal sell-off. So if we're seeing the market sell off 1% 2 days in a row or even more, then remind yourself, hey, this might be a good time to be looking at fade trade opportunities, these bullish fade trades where we're buying the stocks that are slightly overextended to the downside in the very short term. Just a good thing to mentally say, hey, I've seen this before. I know what strategy to apply. For the option selections, and we'll do this again. We'll do this live in the closing playbook. We'll trade this together. Let's wait for the markets to play out today so we can get the best price at the close. But this is what I would look for, typically speaking. If you want to trade basic calls, I would look 7 to 10 days till expiration. Because we're only holding overnight, you're not going to eat a ton of time decay. So look, 7 to 10 days till expiration, and I would go 1 strike out of the money. That's if you want to trade basic calls. But as you guys know, I prefer to use the wrap order. Now, I can't really see ahead. Let me see when I cover. All right. I'll cover here. The wrap order works amazingly well. However, let's keep in mind if it's Monday and we're looking to do this bullish fade trade, most stocks their expirations are on Friday. So if we do a wrap order on Monday and sell it the next day, it's not going to move that much. So know the day of the week. If it's Monday, you're probably going to want to go with basic calls and puts if you're doing the downside. However, if it's Wednesday or Thursday, I would look to use the wrap order because that time decay is going to crush the option that you've sold, which is good for us. It helps us leverage our gains even faster. So this is what we'll be doing in the closing playbook today. We'll be using the wrap order since expiration is tomorrow, and we get to see most of that time decay flush out overnight. And then another way to do it, if you want to use calls that are 1% in the money, that's a way to get cleaner leverage in the sense that you're not going to eat as much time decay. The risk to reward, it's going to be a little bit less risk as far as percentage move. Also, the reward is going to be a little bit smaller. But it's going to be a cleaner leverage in the sense that you're not going to have to stress out as much about time decay as you would have if you do the 1 strike out of the money, basic calls and puts. If that makes sense. We haven't even covered the 1% options here. That's something that my good friend Chuck taught me years ago, back in like 2019. It's really, really cool. They're a bit pricier. They're definitely a bit pricier, but it's another way to offset time decay a little bit better than buying at the money. So with that said, let me go ahead and go here. Let me change this. I want to see why Apple is not showing up for me. If I sort my symbol. Because I think if I do close here, that's going to look at the yesterday's price action. Because obviously stocks have not closed yet today. Let me go to the charts. Yeah, this will include today's price action. I just want to make sure I have it all set up for us tonight. And then I'll go into the chat here and answer some questions here. Again, I'm going to wait until closing playbook to place some trades just because I want to let the market do whatever it wants to do today. If it flushes lower, that makes it even better for us. But make sure to tune in for the closing playbook. We'll cover that there. All right, let me jump over to some questions here. And I'm still curious why Apple has not shown up. Hey, do you have any idea here why Apple isn't showing up?
I think it's on that one. I think it's far right, like 4th or 5th row.
There's APH.
Oh, I might have. Yeah, you were scrolling quickly, so I might have seen it.
Sorry.
Yeah, okay. My bad.
No, I don't know. Let's see.
Let me see if my does anyone have the Thinkorswim version of this scanner? It shows up. Here's the Thinkorswim one. If you guys did Thinkorswim version, it's at the top of the list here, Apple. I'm not sure why it's not showing up in Stock Fetcher. But the Thinkorswim version has, oh, there you go. Whole bunch of stocks. AMD, ANET, which we're playing on that gap fill right now, looking good. AVGO, the one we just talked about. So we'll have a lot of fun. I'll use the Thinkorswim version today just because it'll be easier for me. But either way, I wanted you to have the Stock Fetcher code because I know not everyone has Thinkorswim. So we'll cover that this afternoon. All right, we do have someone posting in the chat. Powell speaks tomorrow, and I do have one final pointer for you guys. And Dave, I think you had something to cover first, maybe.
Yeah, I just wanted to mention for everybody, we start at 10 a.m. fairly promptly every morning at 10 a.m. Eastern time. We have about 500 people in the room, and about half of you are not here at 10 a.m. Not only do we start at 10 a.m., but we also just started this morning doing some pre-show content. So if you want to show up about 10 minutes early, 10 to 10, 9:50 a.m. Eastern time, we have some pre-show bonus content for people who show up a few minutes early. So just want to let you know in case you want to try that out tomorrow.
Cool. Good point. Good point. Can we set this up in FinViz? I'm not 100% sure. LK, do you know if you can set this up in FinViz? All right. I'm not sure. I use FinViz for mostly scanning for earnings. So I've not set up a ton of screeners in there. I have before. Actually, I've set up a gap fill screener in there, which I still need to build that for you guys. But all right. Let me keep on track here. This is what I was going to cover this morning. I'm going to skip through some of this. I'll do it tomorrow. All right, here we go. This is a cool little stat I found. We had some people saying Fed speaks tomorrow, and they do. Well, Powell does with Jackson Hole. What time is that tomorrow? Does anyone know? 10 a.m. tomorrow. Powell is speaking. Here was a cool, fun little fact I found for you guys this morning on what I shouldn't say what to expect because no one really knows. This is looking at every time Powell spoke from the Jackson Hole speech, what happens to the market. You can see 5 days before. Here's what's happened each time. Again, this is 5 plots of data. It's not like we have hundreds of years of data to look at here, hundreds of points. But this was interesting to me. This will be tomorrow at 10 a.m. We'll be here in the opening playbook, but Powell is speaking tomorrow. You can see the day of speech a little bit all over the place. Although keep in mind, guys, these were very different times. Think of August 2020. The markets were in extreme bull mode. Fed was printing big. Interest rates were at 0 versus 2022. That was the bear market. So, of course, you'd probably expect price action like this. However, something I did notice, and this could be good for Friday closing playbook, looking for weekend trades, is let's look at 1 day after the Fed, after Powell's Jackson Hole meeting speech. And does anyone notice anything unique here, regardless of what happened 5 days before, the day of, 1 day after? This is what the market typically does. If anyone notices anything, feel free to point it out. This is what caught my eye today and why I wanted to share it. Mark's got it. Again, we don't know with 100% certainty what's going to happen. However, 4 of the last 5 times the day after, markets have gone up. And this is a smaller move, but these are bigger moves. Anything over a 0.5% move is a great day for the stock market. And this day it was down, but I mean that's really pretty flat. So you notice here, in this case, this would be buying on Friday, closing out on Monday. Typically, when the Fed does a speech from Jackson Hole, this is a good trade to make. So Nate, feel free to mark this one down. We can look at this tomorrow. Also, Nate, this is probably a good little data point for any of the weekend options members as well. Again, anything can happen. We don't have crystal balls, but we can look at data to see what normally happens. This typically would bode well for a strategy like weekend options trading. Even this one probably would have worked for weekend options. So that's a fun one. We'll look at this tomorrow in the opening playbook. We'll track what's going on with the Fed and all of that good jazz. It looks like rate cuts are indeed finally coming for September. We'll see how hard and fast they come. But it looks like even Powell's on the same page now. So we'll cover this tomorrow. Some of you may be wondering, what do I do today? What should I do until the closing playbook starts? Well, we are going to play a little presentation for you that Nate was kind enough to host me on. It's my morning trade that I take each and every morning, targeting around 50% by noon. It had an amazing July, amazing June. I mean, it was like $25,000 in June, or $15,000 in July. August has got off to a little bit of a choppier start. which to me makes me really excited because typically whenever this thing, like I said yesterday, it goes hot, hot, cold, which means hot is coming again. So I think it's a perfect time to be paying attention to this, especially, I've talked a lot about VIX lately, especially as volatility has started to pick back up. This thing is a gold mine in highly volatile environments. So we're going to go ahead and pull that up now, get that rolling for you guys.
I think this is actually the one where Kane hosted you.
Oh, Kane hosted me. Even nicer.
All right.
Go ahead and jump on into this, Kane, and we're going to fly through this, give you guys plenty of opportunity to